Over the last year, we have seen market analysts and macroeconomists warn us of an impending massive oil oversupply named the oil glut. In the summer of 2025, OPEC Plus announced the unwinding of its production cuts. This, paired with the constant drill baby drill energy policy of the new administration and the projected global oil demand plateau, gives us the perfect too much supply, too little demand scenario. So, what does the data show? In the summer, global oil inventories were at the bottom range of the 5-year average. Currently, they are well within average, with the only exception being oil on water. When combined with oil in transit, global inventories show a surplus. However, oil that is tied up in transit or floating storage due to shipping disruptions and constraints is not available for use, as it needs to be completed transporting and creates a false sense of supply cushion. In addition, a significant portion of what analysts call inventory builds is actually oil moving into China's strategic petroleum reserve. This oil is essentially off the market. It isn't meant for commercial trade, yet it is often counted in global surplus figures. Global oil demand, on the other hand, rose 2.4 million barrels per day in 2025 and is at an all-time high. Petrochemicals and urbanization combined with an increase in air travel has provided strong tailwinds for global demand growth, with OPEC Plus forecasting demand expansion all the way through 2050. Irregardless, oil positioning is at an all-time low. Hedge funds and managed money have never been this short crude oil. WTI has fallen 57% from its 2022 peak and has been below $65 since March. The energy sector has been categorically out of flavor, especially while big tech and AI has taken over the spotlight and carries the most weight in the indexes. The oil production numbers, however, paint a different picture entirely. All oil wells have different efficiency rates. The easiest and most profitable wells to drill, Tier 1, have a break-even point around $50 a barrel. Wells of lower-tier rock have a much higher break-even point in the 60s and even $75 a barrel. Producers are eating up their Tier 1 wells just to stay operational, while cutting capex and exploration budgets. To no surprise, rig counts are down roughly 25% compared to last year, and shale production is visibly falling. U.S. production growth is impossible at these prices. In April 2020, oil went to the infamous negative $37.63. In the following months, U.S. rig counts fell from roughly 790 to a record low of only 244. As demand collapsed, so did production and refining capacity. This also began the downtrend of DUCs. DUCs are wells that are drilled but uncompleted, meaning they can come online quickly. Post-2020, this number has reached new lows. In the event we have a sudden increase in demand or a supply shortfall, we no longer have the ability to increase production or refining rapidly. Currently, the U.S. Strategic Oil Reserve is almost half what it was in 2020 due to the previous administration releasing it in an attempt to keep oil prices down. Now, remember the OPEC Plus production cut unwind that we talked about at the start of the video? The announced increase of approximately 137,000 barrels a day of production has actually been an observed reduction in production of approximately 350,000 barrels a day, creating a 487,000 barrel a day shortfall from the initially reported production figures. Not only is U.S. shale production dropping, but OPEC Plus is showing production discipline as well. So, is there an oil glut after all? Or is the price being suppressed due to paper positioning? One thing we know for sure, lower prices means lower production, which means higher prices. Because of this, speculating in oil isn't without its complications, and there are never any guarantees. But as a discretionary trader, I'm always looking for places I can have an edge, or at least define my risk to try and limit my downside. More recently as well, we've seen the beginning of a commodity run, especially with uncertainty around the strength of the US dollar. We've seen gold, silver, copper, aluminum, just to name a few, all breaking out. With oil at 5-year lows, I at least have a strong case to pay close attention and take positions if I see any value opportunities. Let me know in the comments if you have massive surplus of oil near you, spraying out of the ground, or if you don't and you're trying to buy some. I'm always interested to hear both sides of the take. Anyways, Thanks for watching. If you like this info, I always post my market thoughts and market analysis and things. And for more, you can always like and subscribe.